moderating today's panel discussion. Our discussion will focus on how different countries design and implement their monetary policies to maintain price stability and support economic growth. So, today we will be talking on monetary policy in South Asia and beyond. A comparative expert panel discussion. A monetary policy plays a vital role in controlling the inflation, maintaining the financial stability, and supporting the economic growth in every country. In this discussion, our panelists will share insight on how different central banks design and implement their monetary policy, the tools they use, and challenges they face in the recent years, such as inflation, currency fluctuation, and post-pandemic economic recovery. Moving to next, we will introduce our panelists of each country. First one, we have Jamyan Saldan, who will be representing Nepal. She will discuss about Nepal's monetary policy and the important role of Nepal Rashtra Bank in maintaining the price stability, regulating the banking sector, and supporting the economic growth. Second, we have Mr. Sonam Jamsok, who will be representing Pakistan in today's discussion. Pakistan monetary policy is managed by the State Bank of Pakistan, which plays the key role in controlling the inflation and managing the interest rate. And third one, we have Mahon Zamo, who will be representing Bangladesh. She will discuss how the Bangladesh Bank manages the monetary policy to control the inflation and support the economic growth. Please welcome Ms. Mahon Zamo. Fourth one, the next panelist is Mr. Karma Tenzin, representing Bhutan. He will share the insight on Bhutan's monetary policy and the role of the Royal Monetary Authority of Bhutan in maintaining the financial stability. Please welcome Mr. Karma Tenzin. Fifth one, we have Sonam Somo, who will be representing India. She will explain how the Reserve Bank of India manages the interest rate, inflation, and the liquidity of the economy. Please welcome Sonam Somo. Our next panelist, we have Mr. Sring Kinsel, representing Singapore. He will discuss how the Monetary Authority of Singapore conducts monetary policy, mainly through exchange rate management. Please welcome Sring Kinsel. Next, we have Deshna Omo, who will be representing Sri Lanka. She will talk about the role of Central Bank of Sri Lanka and the recent monetary policy challenges faced by the country. Please welcome Deshna Omo. Finally, we have Kinso Chelen representing Maldives. She will explain how the Maldives Monetary Authority manages monetary policy and support economic stability. Please welcome Kinso Chelen. So now let us dive into the discussion. So Jamyan, you're representing Nepal. What are the major challenges faced by the Nepal's monetary policy in this recent years?
Thank you for the question. So without directly jumping onto the question, I would like to briefly discuss about the monetary policy framework of Nepal. So Nepal follows a mixed monetary targeting framework with primary objective of maintaining price stability while also supporting economic growth and financial stability. Unlike many countries that follows pure inflation targeting, Nepal uses broad money supply as operational targeting. And an important feature of Nepal's monetary system is the fixed exchange rate pegged with India, where the Nepalese rupee is pegged at 1.6 with the Indian rupee. Because of this arrangement, Nepal's monetary policy is heavily influenced by the policies of Reserve Bank of India. So this limits Nepal's full monetary independence. In terms of instruments, Nepal's Rashtra Bank uses the policy rate repo and reverse repo operations, cash reserve ratio, and statutory liquidity ratio to maintain liquidity into the banking system. Since Nepal has bank-dominated financial system, monetary transmission mainly works through commercial bank. However, the interest rate channel is only moderately effective due to limited financial market development. Over the past 5 years, Nepal has faced major challenges. During the COVID-19, the central bank reduced the interest rates, provided refinancing facilities and introduced loan facilities to support businesses. Later, during the global inflation surge from 2022 to 2024, inflation rose above 8% due to imported fuel and food prices. In response, the central bank adopted tighter monetary policy. Nepal also experienced foreign exchange reserve pressure, leading to temporary import restriction. Critically evaluating the framework, Nepal faces constraints such as limited policy independence due to exchange rate dependence on remittance and political pressure. While the framework has maintained related stability, monetary transmission remains weak. Now, to answer the question, Nepal's monetary policy has faced several challenges in recent years, mainly due to inflation pressures and external economic factors. The Nepal's Rashtra Bank, had to deal with rising inflation during 2022 to 2024, caused by global fuel and food prices, increases and supply chain disruption. Since Nepal depends heavily on imports, global prices shock quickly affects domestic inflation. Another challenge was the decline in foreign exchange rate reserve due to high imports, which forced the government to introduce temporary import restriction and tighter monetary policies. Thank you.
Thank you. As clearly stated by Janya, Nepal's monetary policy is managed by Nepal Rashtra Bank to maintain price stability and support the economic growth. It uses tools like policy rate and reserve requirement to control the liquidity. Nepal's currency is pegged with India, so its policy is influenced by the reserve requirement. It is influenced by the Reserve Bank of India. In recent years, Nepal has faced the challenges such as COVID-19, rising inflation, and pressure on foreign exchange rates. Thank you. Cut. Second panel. Now let us move to the second panelist. So, how does the State Bank of Pakistan regulate the monetary policy in the country?
Thank you for the question. To answer the question, the State Bank of Pakistan regulate monetary policy in Pakistan to control inflation and maintain economic stability. One main tool is to policy interest rate. For example, in 2023, when the inflation in Pakistan rose by 30%, SPP increased the policy rate to around 22%. This made borrowing more expensive and helped reduce spending and inflation. Another tool is the open market operation, where SPP buys or sells government securities to control the amount of money in the economy. SPP also sets a reserve requirement for bank. By increasing or decreasing the requirement, it controls how much money bank can lend. In conclusion, to interest rate open market option. In conclusion, to interest rate, open market operation, and reserve requirement, the State Bank of Pakistan manages money supply and support economic stability.
Now let us move to the third panelist. Given the recent inflation surge and the currency depreciation, how effective has Bangladesh monetary policy been in maintaining the price stability?
Greetings everyone. So before I answer your question, I will briefly discuss the monetary policy framework of Bangladesh and the role of Bangladesh Bank. Bangladesh Bank manages monetary policy to control inflation and support economic growth. Bangladesh moved from money supply targeting to an interest rate system, including the smart rate in 2023. The bank controls liquidity using tools like repo rate, CRR, SLR, and open market operations. Recently, challenges include COVID-19 effects, high inflation, currency depreciation, and bad loans. So stronger supervision and transparency are needed. So regarding the question, in recent years, Bangladesh Bank has faced significant challenges, especially after COVID-19 and the global inflation shock of 2022 to 2024. Inflation increased mainly due to imported food and fuel prices, as Bangladesh is highly dependent on imports. Initially, monetary policy effectiveness was limited because of interest rate caps and controlled exchange rates. which weakened the interest rate transmission channel. However, recent reforms such as adopting a more flexible exchange rate and introducing a market-based policy rate system have strengthened policy credibility. Overall, while monetary policy alone could not fully control inflation due to external shocks, recent structural reforms are improving its effectiveness in maintaining medium-term price stability.
Thank you. So it means that Bangladesh Bank faced major challenges after COVID-19 and the 2022 to 2024 global inflation shock, mainly due to high imported food and the fuel price. Earlier, the interest rate caps and controlled exchange rate limited the effectiveness of monetary policy. Recent reforms like more flexible exchange rate and market-based policy rates are improving policy credibility and supporting the medium-term price stability. Thank you. Before diving into the question, first let us hear about the Bhutan's monetary policy.
Good morning, everyone. I will briefly present the monetary policy framework of the Kingdom of Bhutan. First, I will talk about the monetary policy framework, then the instrument and its operation, then the transmission mechanism. Then I will talk about recent policy changes that happened in between 5 years. Then I will do a critical evaluation of monetary policy framework of Bhutan. Firstly, Bhutan follows an exchange rate-based monetary framework. The neutrum is pegged at par to the Indian rupee, meaning our nominal anchor is the fixed exchange rate rather than an explicit inflation target. This peg ensures exchange rate stability and facilitates trade with India, which is Bhutan's largest trading partner. The Royal Monetary Authority operates with functional independence but works closely with the government, particularly due to Bhutan's small and open economy. Communication is done through monetary policy statements and annual reports. Now, moving to instrument and operation, Bhutan uses several key tools like the policy rate, also known as bank rate, and the CRR, which is cash reserve ratio, which is requirement for every bank, and open market operations, mainly through issuance of royal monetary bills, liquidity management tools to control excess credit growth. However, because of exchange rate peg, monetary policy autonomy is somewhat limited in Bhutan. Then, to talk about transmission mechanism, the interest rate channel exists but is moderate in effectiveness due to dominance of the banking sector and limited financial market depth. Then the banking sector plays a central role in credit transmission. Additionally, Bhutan is highly sensitive to exchange rate and capital flows from India. Then recent policy changes that happened between last 5 years. Bhutan faced significant challenges, including COVID-19, which required liquidity support and loan deferment measures. The global inflation surged between 2022 and 2024. Rupee shortages due to import dependence. Then, lastly, the critical inflation. The main constraint for Bhutan is limited monetary independence due to currency peg and high import dependency. While the framework is credible and ensures stability, reforms are needed to strengthen financial market development, improve liquidity forecasting, and enhance micro-prudential tools.
Thank you, Mr. Karmathin, for giving us the insight about Bhutan's monetary policy. So jumping to the question, Bhutan does not follow the inflation targeting like India. Is that a weakness?
Firstly, thank you for the question. Bhutan's framework is different but not weak. Unlike RBI or Reserve Bank of India, which uses inflation targeting, Bhutan uses the exchange rate peg as its nominal anchor. Because Bhutan imports most of its goods from India, inflation in Bhutan is largely imported. Therefore, maintaining exchange rate stability is more effective and targeting inflation independence. Thank you.
Thank you, Mr. Karmathin. For a small, highly import-dependent economy, closely integrated with India, an exchange rate anchor can be more effective and credible and independent inflation targeting. Moving to our fifth panelist, India has recently been recognized as one of the fastest growing major economies. However, we have seen the Reserve Bank of India hold its benchmark interest rate steady in its latest February 2026 monetary policy meeting. As an expert of India, could you explain how the RBI's current monetary policy framework balances its balances this robust GDP growth against the global geopolitical risks and the specific challenges dictate your current policy stance?
Before I discuss on your question, thank you for having me here, and it's a privilege to sit here with you all as an expert from India. So to respond on your question, the Reserve Bank of India operates under the flexible inflation targeting framework, and right now India is uniquely positioned in what we call a Goldilocks, a zone of strong growth and contained inflation. In our most recent February 2026 meeting, the RBI as one decided to keep the benchmark repo rate unchanged at 5.25% and maintain a neutral policy stance. This comes after a cumulative 125 basis point cut over the previous year, and we hit the pause button because of our inflation is well managed, projected, and at the beginning 2.1% for fiscal year 2025 to 2026, while our economic momentum remains exceptionally strong with our GDP growth forecast recently upgraded to 7.4%. And our major policy challenge right now is primarily the external, with growing geopolitical tensions and the volatility in international energy prices and the unpredictable global financial markets significantly downside the risks, and we also have to remain watchful for volatile food prices caused by the unpredictable weather events. And in conclusion, to navigate these challenges, the RBI is relying heavily on dynamic liquidity management rather than aggressively cutting rates. We are utilizing the active tools like open market operation to ensure adequate credit flows to the economy. My primarily policy recommendation is to maintain this data-dependent neutral stance, and this approach allows the pass rate to fully transmit to the banking system and ensuring we support domestic growth with leaving our economy to a global price shock. Thank you.
Thank you, Ms. Somsomo. It means that the RBI is keeping a balanced and cautious policy by holding interest rate steady. This helps support strong economic growth while protecting the economy from global risks and price volatility. Next, we have Mr. Srimutinso. So, how the monetary policy of Singapore respond to external economic shocks such as global financial crisis or inflation pressures?
Before answering this question, I want to talk a few things about Singapore. Singapore is a small island in Southeast Asia, which is highly developed and open economic. And despite having few natural resources or limited natural resources, it is a major global hub of business, finance, and trade. And it is all due to institutions such as Monetary Authority of Singapore. And the answer to your question is Singapore's monetary policy is managed by the Monetary Authority of Singapore. In short, it is called MAS. And unlike many countries that uses interest rate, Singapore controls its economy by controlling its exchange rate of the Singapore dollar through Singapore's dollar nominal exchange effective exchange rate system. And when Singapore faces external economic shocks such as global financial crisis or even few years ago due to COVID pandemic, Monetary Authority of Singapore made its monetary policy by allowing the currency to depreciate slightly. This helps exports become more competitive and supports economic growth. And MAS also ensures that banks have enough liquidity so they can continue lending to businesses and households. And when there are inflation pressures, MAS allows the Singapore dollar to appreciate, which makes imports cheaper and helps control rising prices and overall the role of monetary authority of Singapore is to control inflation, maintain financial stability, regulate the financial system and respond quickly to global economic shocks to keep Singapore economy stable. Thank you.
Thank you, Mr. Srimpito. It states that Singapore's monetary policy is managed by the Monetary Authority of Singapore. Instead of mainly using the interest rate, it controls the economy by managing the exchange rate of Singapore dollar through the Singapore dollar nominal effective exchange rate. And second, during the external shocks like global financial crisis or the COVID-19 pandemic, MAS may ease policy by allowing the currency to depreciate slightly and boosting the export competitiveness and supporting the growth, while also ensuring the banks have enough liquidity to continue the lending. Moving to next, what are the main monetary policy instruments used by the Central Bank of Sri Lanka to control the inflation and maintain the financial stability?
So, firstly, thank the moderator for giving such opportunity. And secondly, I'm really glad to be one of the panelists here with you all. And before directly jump into my question, I will tell background of the Sri Lanka monetary policy. So Sri Lanka monetary policy framework has evolved significantly over the past few decades. So now, if I answer your question, the Central Bank of Sri Lanka uses several monetary policy instruments to influence economic activity and maintain inflation around 5% a year. And the main instrument is to oversight policy rate, that is OPR, which signal the central bank's monetary policy stance. By increasing or decreasing this policy rate, the central bank influences short-term market interest rate and borrowing costs in economy. So another important tool is open market operation, that is OMOS. Through OMOS, the central bank buys or sells government security in the money market to manage liquidity in the banking system. And this helps guide short-term interest rate towards the desired level. So the average weighted call money rate, that is AWCMR, serves as the operating target, meaning it reflects the short-term interest rate conditions in the interbank market. The central bank uses liquidity operations to keep this rate close to the desired policy level. So finally, in addition to that, standing lending and deposit facility allow banks to borrow or deposit funds with the central bank overnight, which help stabilize short-term interest rate fluctuation.
Thank you, Tishinomo. It means that the Central Bank of Sri Lanka controls the inflation economic activity mainly through overnight policy rate (OPR), supported by open market operation. The average weighted call money rate as the operating target and standing lending and deposit facilities to manage the liquidity and stabilize the short-term interest rate. This would be our last question for the Maldives. Why is the exchange rate stability important for Maldives economy?
Before answering your question, I will briefly introduce Maldives. Maldives is a small island country located in the Indian Ocean, southwest of India and Sri Lanka. The official currency used in Maldives is the Maldivian rupiah. The country's monetary policy is managed by the Maldives Monetary Authority. The economy of Maldives mainly depends on tourism, fishing and services, with tourism being the most important sector contributing to GDP and employment. To answer your question, exchange rate stability is very important for Maldives because the country import most of its food, including food, fuel and other essential products. If the value of the Maldivian rupiah falls, import becomes more expensive. This can lead to the higher inflation and increased cost of living. Therefore, the Maldives Monetary Authority tries to maintain a stable exchange rate against the United States dollar. And a stable exchange rate helps control inflation, maintain economic stability, and support tourism and trade. However, maintaining an exchange rate stability can also be challenging because Maldives depends heavily on tourism, revenue, and foreign currency inflows. Thank you.
Exchange rate stability is important for Maldives because the country imports most of its goods, including food and fuel. If the value of Maldivian rupiah falls, imports become more expensive, leading to higher inflation and higher cost of living. Therefore, the Maldives Monetary Authority works to maintain a stability exchange rate against the United States dollar. So, with respect to time, now let us wind up our panel discussion. So, thank you all our panelists for their insightful presentations. Today's discussion highlighted how different countries use different monetary policy frameworks depending on their economic structure and the challenges. For example, countries like India and Sri Lanka focus on inflation targeting, while economies such as Bhutan and Singapore rely more on exchange rate management to maintain the stability. We also learned that the central banks such as Reserve Bank of India, Royal Monetary of Bhutan, and Monetary Authority of Singapore respond to global challenges like inflation, financial crisis, and economic shocks. Overall, the discussion shows that while monetary policy tools may differ across the countries, the common goal remains the same: maintaining price stability, supporting the economic growth, and ensuring financial stability. Thank you all to our panel and audience for being part of this discussion. We hope this session has provided a valuable insight into the role of monetary policy in the different economics. Thank you.